After the most aggressive interest rate hike in 40 years, the Federal Reserve is expected to approve another quarter-point increase tomorrow.
There is growing expectation the central bank will take pause to see how the economy responds. So we have Fox 26 business reporter Tom Ziska joining us to break all this down.
The experts are saying there's a chance that this may slow down, at least for now. The Fed started raising rates 13 months ago from 0% to an anticipated 5.25% after tomorrow's announcement. They've been trying to make borrowing more expensive so we will spend less, which is supposed to help bring inflation down.
This has been a dramatic tightening of policy over a very short period of time.
Houston economist Sam Ryan says a number of factors have kept inflation stubbornly high, prompting the fastest rise in rates ever. And it's been having some effect. A government report that the Fed watches closely showed year-to-year price growth fell to 4.2% last month, down from 7% a year ago. But companies are still hiring and paying workers more as a sign that demand continues. Rines is not convinced that the Fed is done just yet.
Are they going to continue on the path of quarter-point rate hikes, or are they going to allow themselves time to see how the economy is doing, how inflation evolves, and whether or not they need to continue raising rates?
Inflation and higher borrowing costs over the last year have taken a significant bite out of household budgets. The nation's credit card debt neared $1 trillion by the end of 2022, with the average balance for Texans sitting at $8,700, according to a LendingTree analysis. The average credit card interest rate now sits at 20.09%, up from about 14.5% when the Fed started. The difference, making just minimum payments, equals more than $18,000 in added interest fees.
If you're consuming on a credit card or consuming via credit in general, call it a two-sided hit that has really been painful. And until inflation comes down, that's not going away.
So if the Fed signals tomorrow that it is willing to let the economy simmer with rates as they are, there will also be an understanding that if inflation prices tick up, job growth gets hot, more rate hikes will be coming as well. With the possibility of a recession still very real, there is no expectation that those rates will go down any time before next year at the earliest.
All right. We just keep seeing everything go up like that.
Be prepared for the long run.
All right. Thanks, Tom. Yep.